All right. So thank you guys for joining another exciting rendition of the Purchasing Division's Lunch and Learn series. Today we have Insurance Office of America, IOA, and our presenter is Barry Bonds Page. He's a vice president of Surety there. Um, just before we get started, some things about Barry. Barry Page brings over 30 years of surety experience to IOA, where he's led the national bond operations for the past 13 years. Based in Longwood, Florida, Barry provides strategic support to IOA offices nationwide. Before joining IOA, Barry served as a surety underwriter and later as CEO of one of the largest bond-only agencies in the U.S. His core strength lies in establishing surety lines for emergency contractors and crafting innovative solutions for hard-to-place accounts. Barry is also one of the only 12 agents nationwide serving on the agent council of one of the largest U.S. surety companies, reflecting his leadership and influence in the industry. Some of his key industry memberships are the Surety and Fidelity Association of America, National Association of Surety Bond Producers, Society of American Military Engineers, National 8A Association, and the Construction Financial Management Association. A couple of fun facts about the IOA is they're the official insurance broker for the Raiders, the Grizzlies, the Capitals, the Hornets, the LPGA, the Mystics, and the Tampa Bay Lightning, just to name a few. Um, just right before we get started, I'll turn it over to Barry. I see Bob is on. Bob, would you like to give a couple of words before we start? Sorry to put you on the spot. What happened to Bob?
Well, I think maybe he's muted. Yes. Oh,
Let's see here.
spoiled by technology.
Yes, exactly. Let me unmute. Where is Bob? Let me find him. Okay, seems like everybody's muted. So while I fix that, we'll go ahead and just turn it over to Barry, and I'll fix that while he's doing his spiel. Everybody, once again, this Barry Page. Take it away,
All right.
Barry.
All right. Hey, thanks, Kirk. Well, thank you and welcome everybody and welcome to agreeing to spend some of your lunchtime learning about the most exciting topic of surety bonding. Um, I was sharing with Kirk. I guess at the end of this, you'll figure out why people avoid me at cocktail parties because it's not the most exciting stuff, though. Obviously, I get very passionate about it. I've been doing this quite a while. So basically what we're trying to do today is just to give you a little overview on bonding, basically from the perspective of the public owner. It's a little bit different than from the perspective of the contractors. Um, but hopefully you'll get something out of it. And I am definitely available. We'll certainly want to make this interactive. So if you have questions throughout, feel free to raise your hand um, and Kirk can hopefully transfer the questions over. So
Yep.
um, you think
Go ahead.
Oh,
You're
okay.
good.
Just wanted
Yeah,
to
we're
say
good.
I wasn't sure what was going on there. So
Right.
anyway, that is, yep, we already went through that. So real quick, um, there's a kind of a couple of things in the industry. Like a lot of our insureds that don't understand the difference between a bond and insurance. Bonds are a credit product, whereas insurance is insurance. And by credit, it's surety is unique in that if you go and you're going to get an insurance policy, it's an agreement between you, the insured, and the insurance company. If there's losses, the insurance company pays your claim, and you're made whole that way. I don't want to get into the details of insurance, but most people have a pretty good understanding of what an insurance policy does. Whereas the way I like to look at surety is that the bonding is basically a professional co-signer. So what they're doing is they're guaranteeing that the third party, which is in this case the principal, the contractor, is going to do what they say they're going to do per the terms of the contract, and that any of their suppliers and subcontractors are going to be paid along the way. So, so the purpose of the surety bond is basically is to be a protector of the public's money, to make sure that the public is getting, the taxpayers are getting what they signed up for, basically, or what the contract is. So one of the other unique things, whereas insurance companies anticipate losses, the goal of the surety is to underwrite to a zero loss. Now, I say their goal is to underwrite to a zero loss, but as an industry in the US last year, the surety industry paid out over $1.5 billion in surety claims. So somewhere along the line, somebody didn't get the message that, that is for a zero loss. But there's a lot of factors that go into why that happens. And also know that in Florida is, when they do the states and territories, Florida is number 3 as far as states that have had the largest surety losses. And part of that was skewed by, actually it was from the Florida Department of Transportation, a large job of down in Tampa, where one of their large road projects, the contractor went bankrupt. But as a surety bond's supposed to do, they have replacement contractors in, project keeps moving. We'll spend too much time on that. So, first thing is just so you know, again, why is it done? Well, this is really pretty simple. So in the federal arena, there's something called the Miller Act, and the Miller Act requires that any public construction on federal projects, I believe the threshold is let's say is probably 200,000 for the federal government right now, but Florida mirrors that. They call them mini Miller Acts. So I put the code up there as to why it's required. So, if you have like a small $400,000 job for, let's say, rehabilitating a government building in Fort Lauderdale, by law, you have to require a bond. And I'm sure you guys are all aware of that already, but at risk of restating the obvious. Now, then you get into the fine line as to, is it considered public construction or not? Like, for example, janitorial contracts are not required, are not subject to FS 255, yet we do have several counties throughout Florida that do require bonds even for service work, like lawn maintenance, janitorial work. So, but for the most part, construction is required to have bonds in Florida. So we also put it. I'm not a big believer of reading slides to adults because you guys, I assume most of you guys can read. But
yeah, and I'm going to share the presentation with everybody afterwards as well. So you're good there.
Oh, great. That's good to know. But again, the biggest thing is, as a taxpayer, you guys have from the easy to the complex jobs out there. I mean, the surety bond is the mechanism to protect the public's money. If you think about it, if just say you're getting some work done on your personal home, there's different. You're not going to get a bond. And actually, the sureties won't bond a private home in most cases, just because they're not dealing with. You kind of. Well, there's a lot of reasons for it. I can go on for about 15 minutes on that, but won't. But the big reason for that is that you have sophisticated owners versus non-sophisticated owners, and owners of real estate, private real estate, are not necessarily considered professional, and you kind of get into a real easy contract disputes. So the sureties shy away from those. But let's just say if a homeowner doesn't pay the surety, or sorry, the contractor doing work in their home, the contractor has remedies, and the biggest remedy they have, besides just suing the owner, is they can put a lien on the public property. I'm sorry, on the private property on your house. I don't know if people are aware of that. So, like in your home, let's just say you're having a major kitchen remodel done, and your contractor you hire doesn't pay, let's say, the cabinet maker. That cabinet maker has the right to put a lien on your property and can ultimately foreclose on it. Well, as you all probably know, you can't put a lien on public property. So the bond takes the place of the lien rights, if that makes sense. So that's really the reason why the bond requirement exists, because it takes the right of takes the place of the liens. So this is a little bit different because usually hearing feedback as we're going, and I can't see the board faces or anything on here. So so anyway, if you do have some questions throughout, just raise your hand, and we can stop and answer whatever questions there are.
And while you're doing that, Bob is situated, so he can jump in and.
Oh, go ahead. All right.
No, so thanks very much, Barry and Kirk, for mastering the technical aspects of mics and cameras. That can be tricky, but no, this is very helpful, and I was letting it sort of flow, Barry, because you're hitting the right points. Part of the background on this is, as you know, in procurement, we have some specific types of bonds, and a lot of the practitioners here, we go through the motions, but sometimes we don't ask the questions behind the questions, or the issues that underlie some of the questions that might be asked. So you're addressing the risks that we have in negotiating public contracts and solicitations. And we have things like, we have bid and proposal bonds, we have maintenance bonds, we have payment bonds, labor and material bonds, performance bonds. And I'm reading through the list. So you get the idea. There's all kinds of bonds. So these being
from the laptop, it comes from the
Can you
laptop.
guys mute your microphones, please?
Yeah. So I think these are all tools, right, to address risk at specific points in the process. And so as you go through this, if you could kind of highlight where you believe it's helpful for the purchasing practitioners to manage the public risks. And as you point out, we're like fiduciaries. We're handling the public's money, and to make sure that it's done appropriately. I appreciate the knowledge and the expertise that you bring here. So thanks a lot, and I'll let it play out here.
All right, Bob, thank you so much. Actually, that's exactly right. But we talk about completion of projects where the bonds for you guys would encompass everything from site improvement work, and that's kind of an interesting one, because it's usually like you have if you have a high rise going up on down in Fort Lauderdale, that's private construction. However, what's not what do you do when the contractor has to widen sidewalks? Maybe they're encroaching on a busy road, putting stoplights up. Well, the city or county shouldn't have to pay for that, right? So they'll have a mechanism for a site improvement bond, which is something that people don't. That's not a direct project where you're rehabilitating City Hall. This is actually so there are some public bonds required for some private work, and those are called site improvements. Of course, the easy ones are road work, sidewalks and drainage, stormwater, utility extensions, and all those things. The other thing that the bonds will do, and we actually, Kirk and I touched on this a little bit, which are not your normal performance bonds, which are, you can also have bonds that ensure compliance with your codes and permits. And that's pretty important, especially when we had that catastrophe, for example, in Sunrise a couple of years ago, when a lot of people got hurt, injured due to what happy structure that was not engineering, that was not sound from an engineering standpoint, and we had the bridge collapse a few years back up in also the same thing. Well, had it been under a maintenance or warranty period, the surety actually, one of the things they do guarantee even after the project is complete is to make sure that it was done per the specifications that were set forth in the RFP or the IFQ and the contract ultimately. And that does happen more than you think. I mean, I do this nationally. I know up like in Sacramento, California, there's a major issue going on right now where on a federally funded, it was a joint venture between the feds and the state, where they're doing a section on Interstate 80 and State Road 50, where this is a 3-year construction project where at the end of it all, they figured out that the concrete used was not made to the standard that was in the specifications. And we're talking hundreds of millions of dollars, and all that work had to be redone. And, it's the surety that's stepping in to pay for it, because, it's even for a large contractor, the repair work is so large, the contractor couldn't afford to go and do it again. And that's where the bond steps in. And you think like that stuff doesn't happen, but I mean, it does happen more than you think. So, again, the maintenance after the construction is important. The other thing too, and again, it may not be on the forefront of, from your standpoint, because you ask for a bond, they get a bond, they say, okay, we're going to go build this. But I think one of the strongest things that the bonds guarantee is guaranteeing the payment obligations. And it's not just the payment obligations for your major subs, but most of your larger work is going to have a general contractor. In other words, they don't do it self-perform anything. They just have a series of subcontractors. Us in surety, we always recommend that they require bonds of their major subcontractors to alleviate some of the risk back to the GC. But a lot of them just are contractors in general tend to be very optimistic, and they always think they're going to make money. They never think there's going to be an issue, and they always think everyone's going to do what they're going to do. But as we know in life, that seldom works out that way. So the bond is a good big stick to make sure that does in fact happen. So what are the things the payment bond does? And I'm going to get into the three major bond later in the presentation. But the big thing is to making sure that that the third or fourth tier subcontractors get paid on the job. So let's just say you have, I don't know, Suffolk Construction is doing a major project down there, and then they have someone that's doing they hire a big commercial plumber to do the plumbing. Well, that plumber may actually subcontract out portions that are outside of their expertise. And so even though Suffolk may not have a contractual relationship with the third and fourth tiered subcontractor, their bond still guarantees that third and fourth tiered contractor who they don't have a contractual relationship with also gets paid. And that's a key point. So again, that person, there is no lien rights. So the bond takes the place of that. And I'm sure in purchasing, you probably have gotten some inquiries or some letters from just one of like a painting contractor saying, we didn't get paid on this job. What do we do now? And hopefully you steer them towards the bond to remedy that, because it's not your responsibility to make sure they get paid. It's the surety's responsibility to make sure they do. Let's keep moving on here.
Yeah, while we're looking at that, I know we only have about another maybe 15 minutes to go through.
Yeah,
this.
I'm going to go.
Can you get
faster.
into some of the bonding basics?
Yeah, that's what we're going to do. So basically, well, actually, I do have that, but I just want to touch on real quick is that you also have to be careful with the sureties of the bonds that you're accepting. Hopefully that your guys are getting AM Best A-rated companies, that the surety is licensed to do business in Florida, and that there is a Florida attorney, in fact, signing the bond. And we did say local governments can't override the Florida statutes, but that's a whole other topic, which probably doesn't need to get into. But we did have like one of the municipalities in Florida, real quick, did require, they came up with a requirement that said, well, we have to have Florida domiciled surety companies as the only bonds they would accept. And then we pointed out, well, that's great. There's only 2 insurance companies in the entire country that are domiciled here in Florida. And that means that companies like Liberty Mutual and whatnot are that. So, be careful if you're trying to protect yourselves to make sure that whatever you're doing to protect yourselves is still reasonable. And there are some things that are problematic for the surety, like I say, that make it difficult for contractors to qualify for the bonds, like long workmanship warranties. 5-day demand would be a problem, and then long completion times. The other thing from your standpoint, again, contractor, you need to provide a bond. Well, they do, and then how do you make sure that the bond is actually legitimate? The first thing is that you look for is that attorney. In fact, it's the power of attorney that actually authorizes that agent for signing on behalf of the surety. And something you guys may not realize, that let's just say that there's an agent out there that is supplying bonds fraudulently, and there's been cases like that happens. if it's a valid power of attorney, even if the bond wasn't approved by the surety, that bond is still going to be valid as long as there's a valid power of attorney attached to it. Because what's happened is the surety company has given that agent the power to obligate the surety to the contract. So, so just so you know, if the surety says that Liberty Mutual it receives a claim from you guys on a bond, and they say, we don't even have a record of this bond. If it's one of their agents with one of their power of attorneys, they're still obligated to pay out on the bond, even if they didn't authorize it, because they've transferred that authority over to the agent. And this is our surety parties. We covered that, where you have the principal, surety, and obligee. You guys would be the obligee in that case. Again, if you can stop me if I start going too fast through this stuff. But as Kirk said, he'll have his presentation for everybody after the fact. So, so from the contractor standpoint, the biggest benefit for the public and for what you are doing for the contractors is that the surety pre-qualifies the contractor. And what it means is that it's the surety's responsibility to make sure that that contractor is qualified to do what the work is. And so what we do is, from the underwriting standpoint, is we're looking at we call the 3 C's. We're looking at, have they done this work before? Have they and like, let's just say we're a plumbing contractor. You have plumbing work. Well, a contractor that has done let's say $1 million plumbing job may not be qualified to do a $10 million plumbing job. And so the surety will pre-qualify so we get to see what the if they're qualified to do it. So there's been a big push, and actually from the federal government and most of the state governments, for the small businesses, the independent contractors. So then the question is, if the more requirements are favor the large contractors, even bad bond language and stuff like that, because the larger people, sureties will write bonds for bad contracts for the larger contractors because they have the financial wherewithal to do it. So there's some pluses and minuses to that. The biggest disadvantage to going with the larger, biggest companies it's going to cost the taxpayers more. Typically, their overhead is higher. It's not, you think that the larger people can do it cheaper, but they don't. They have layers of management. Also, we have a lot of programs for the small businesses, disadvantaged businesses, veteran-owned businesses, which actually is one of my specialties. That's what I do, is I help them get that. And so, basically, the small contractors tend to be more localized. So if you're trying to give business to, let's say, a smaller emerging contractor, and you can actually give them a bid preference, it's legal to do that if they qualify for a small and disadvantaged business. The advantage to that is that you're helping your community and they're putting money back into the local economy. Whereas, again, I'll pick on Suffolk Contracting. They're based in Boston, Massachusetts. So if you use some of these big guys, the money's not staying in Broward County, it's going to Massachusetts. And there's nothing really wrong with that. But having a requirement or given a preference for the more local businesses, small businesses, women-owned businesses, disabled contractors, helps everybody. It helps those contractors get larger, but it also helps the local economy, and it puts money back into your local thing. And again, as long as they have a bond, there is no risk to using a smaller contractor. One other thing too that I should probably touch on here, and I did with Kirk earlier, is that the SBA has a bond guarantee program. And most of the agents, the surety agents in Florida, don't have access or don't know how to even place that business. So I only bring that up is if someone says, hey, I just can't get a bond, it's just a simple question to ask them. Hey, have you tried going through the bond, the SBA bond guarantee program? Now, there are qualifications that if they really don't have money and they really aren't qualified, they're not going to do it. But in my experience, there's been several contractors who, I mean, a lot of the people who turn to IOA and come to us are saying, hey, we couldn't get this bond. I said, well, did you go to the SBA? He said, no, it wasn't even brought to our attention. And I mean, we just wrote 2 bonds for Orlando Airport last week for just in that scenario where the guy couldn't get a bond. We got them through the SBA in less than a week, and they're off and running now. And so it's just a question to ask. And again, the program's out there. The downside to the small contractors is their bonds will cost a little bit more for them than the larger guys, just because of its economies of scale. They haven't been around. They may not have reviewed financial statements. A lot of reasons for that. Actually, I think I'm getting close to running over the time. So
we don't have any questions yet. So just barrel on and just get to the bonding basics. Let's keep going.
Okay, good enough. So anyway, yeah, this is just kind of, I just had this slide just kind of show some of the flow. There we go.
Yeah, and there's a link. I think that was Bob that just put the link into the SBA program for the guarantee.
Right. And you'll see that there's several agents that are listed on it. We're like for us, there's a handful of us that are actually have direct access. So if I get a request, I go right, I can apply on a contractor's behalf directly with the SBA, which is another level. Most of the agents, if they do access the SBA, are just sending the files up to one of the surety companies and asking them to go through the process. So, and that takes a little bit more time. But anyway, I just bring it up as there being something that they're able to do. So anyway, so real quick, we'll go through the different bond types. So the bid bond is you guys are familiar with those. That's the first thing. So the sureties will approve the bid bond with the understanding that if the final bond is required, that they're going to provide it. The measure of damages is the difference between if the performance bond is not issued after the fact, is the difference between that bidder and the next qualified bidder. So that's where it's like, I think you guys require like a 10% bid bond, if I'm not mistaken. So that 10% of the bid, $2 million project, that gives you a $200,000 room to compensate you if the guy who was low bidder, or sorry, the contractor who was low bidder wasn't able to give you the final bonds for whatever reason. Your measure of damages is the difference between them and the next contractor. And it's amazing to me, a lot of municipalities don't enforce their provisions of the very bid bond. They just kind of go to the next one, which costs the taxpayers money, of course. And that doesn't count for like things like bid mistake or something like that. But that's a whole other subject too. Performance bond is real simple. It's just that they're going to perform within the terms of the contract. So if say the street's supposed to be 12, or sorry, this lane's supposed to be 12 feet wide, they only made it 10 feet wide. Well, that's a performance issue. So the contractor should fix that. And if not, you can have another contractor go in there once you've declared them in default to go in there and actually completes the contract. I think I've already touched on the payment bond, but that's that by the way, just an anecdotal. But more than 90% of our bond claims are not on the performance part, but are on payment. In other words, over 90% of the bond claims are on the payment side. Somebody didn't get paid. Contractor did the work, finished it, but they didn't pay for the work. Again, no lien rights. So the surety actually then goes and makes the payment. We'll pay those suppliers. And that's one of the, I think, the largest benefit for you guys is that when you have a bonded work, you know that everybody down the line that did anything for that job is going to get paid. Now, the warranty bond, there is no premium charge for the warranty bond within a year. So the surety will already give them a year of workmanship. That is different than like than manufacturer warranty. So let's say you're having large HVAC units. Well, a 1-year warranty on HVAC isn't going to do very much for you. But what happens is that there will be a pass-through warranty from the manufacturer of the HVAC unit. So they may have a 10-year warranty on those units. So that's still valid and that's fine. In most cases, those contracts will actually pay for the workmanship issues. When we say the industry standard is a 1-year workmanship. So sidewalk contractor gets done and 6 months later, there are major cracks in the sidewalk. That contractor is supposed to repair that work, and that's workmanship. When you get outside the warranty period, well, then it's not. But it can be problematic for the surety once those are outside of the industry norm of 1 year. If they're, the sureties will go to 2 and 3 years, 3 years being the max. And you cannot get a 5-year workmanship warranty. It doesn't exist. If for any other reason, the surety doesn't even know if the contractors, and especially some of the smaller ones, will be around 5 years from now. But they can get years 2 and 3, but there's a premium charge outside of the year for it. And it goes without saying that those things are really important, because when a job is done and you guys go and inspect it, it's fine on inspection, but especially when you have like large weather changes or for whatever reason, things do happen, things break. You want that contractor to go back in and fix their work. Yeah, I think I just addressed with the 3 types. Are there any questions on the basically the 4 bond types?
None so far.
Okay.
Carry on.
Easy enough. So this is real quick. So I touched on this briefly. So this is the biggest benefit of why the bond is is good. And this is something that we talk a lot to the contractors who don't have bonding. So the surety is going to underwrite on 3 areas we call the 3 C's. Capital is, do they have the financial wherewithal to do the work? So, I mean, there's a cost to mobilization. There's a lot of prepayments that these contractors have to make, and there's always a lag between the work being done and when they're getting paid from the county. And what we don't want to see is a contractor defaults because they can't cash flow their own projects. And that's a whole surety thing. So one of the things that surety underwriters are going to look at is, do they have enough money to cash flow their project? Capacity is real simple. It comes down to, are they qualified to do this work? So again, the surety underwriter is going to look at what they're trying to do. Have they done this kind of work before? Have they done this size work before? Interesting fact, number 1 cause of contractor failure is jump in job size. So, just because, they did great on this $1 million job does not qualify them to do a $20 million job. And so, as a rule of thumb, sureties will take a hard look, and by standard underwriting, if a job is more than 2.5 times larger than the largest job they've ever completed, they're going to have a really good reason why this one makes sense to them. And again, we have to protect sometimes the contractors from themselves, because I've never had a client come into our office and say, yeah, we want to bid on this $10 million job, and I think it might put us out of business, but I think we're going to go for it anyway. I mean, they always think that they can complete whatever's in front of them, and they look at it, look, this is 10 times bigger than we've done. We're going to make 10 times more money. Doesn't quite work that way, especially, I don't know if you guys have noticed this, you should, but the larger the project, the more narrow the bid results are. I don't know if you guys have seen it, usually it's really odd for, the lowest bidder, the next qualified bidder, to be more than even 5% off from each other. When you have like $100,000 or $200,000 project, we can see big bid spreads just because it's by a percentage. But when you're talking like $10-20 million, you're talking about a very, very narrow margin. So if somebody's 15-20% lower than the next qualified bidder on a $10 million project, I mean, right off the bat, the surety's going to think there was a mistake made, because all these people can't be wrong. So we always ask them, go back through your numbers, make sure you didn't make an error. And that's also, of course, where the bid bond comes in as well. But capacity is really, really important. And again, anecdotally, there's a lot of the surety claims, actually it's not anecdotal. I mean, the facts are that we have contractors, biggest reason for their failure is, contractor said number 1 reason for failure is a jump in job size. Number 2 is going out of their geographic area. So I'm also, from our standpoint, we're pretty leery if we have a contractor coming down from Jacksonville to do a project in Fort Lauderdale. They've never worked in South Florida. They've never worked with the subcontractors down there. I mean, it's a huge risk, as you can imagine. But when the economy starts turning, you'll start seeing contractors coming in from all parts of Florida and even outside of the area to try to chase work. And that's always a risk. And the surety tries to protect the contractors from themselves, if that makes sense. And then character is just that, we'll go and reference their do references on their previous work. What have they done before? Have they paid their subcontractors? And by the way, and some of our counties we'll call some of the public owners saying, hey, I saw that Suffolk just finished XYZ project. How are they to work with? And hopefully you guys, if you ever get those calls, you can say, oh, they were satisfied. I know there's only so much you can disclose without any detail, but hopefully you're willing to give references for contractors that you've worked with and say, yeah, that was good, or no, it wasn't good. So. Yeah,
really quick, Bob. Do you have an example of a worksheet or checklist of the review process that the surety might use to judge a contractor's capacity? If you have a checklist, maybe you can share that later. That I can share with the team.
Yeah, actually, I'm just trying to think, because I've got our outline. I'll share with you our underwriting outline.
Okay.
Which is the write-up. So when I do a write-up to a surety markets, it's like it's a 3-page thing, but I can hit all the areas that that's not a secret. That the surety is looking at to qualify a contractor. And it's pretty in depth. I mean, I should also really quick say too, the smaller the contract, the easier the bond is to get. A contractor can, if they have good personal credit, they can get up to $1 million bond now just by having good credit. No one's looking at their financials, and the rate's going to be higher. They're going to be paying like 2.5% to 3% premium versus like a premium like 1% or less. But it's almost underwritten like it's insurance. So obviously the 3 C's, there's only 1 C. Do you have good credit? And so we don't even know if they have money or not. But the insurance market, we call it a soft market right now, will write bonds up to $1 million on a signature alone right now. Personally, being an old school surety guy, I'm against it because I think, well, how do you know? But but you'll see some of that, and that's where you will see that. But that's the line of demarcation where if it's 1,100,000, a lot more underwriting goes into it. But at $1 million, just takes a signature.
Okay, so running out of time now. Can you go into some maybe before we run out of time, some of the costs in getting a bond?
Yep, absolutely. So generally speaking, bonds are based on our cost on a sliding scale. So again, we went through the small guys with the signature bonds, we call them short form programs, which will charge 2.5% to 3% of the contract amount for the bond premium. Then you get into the next tier, which is there's some underwriting. Maybe they don't have CPA reviewed financial statements. We can get up to like 2.5 million on those. The surety premium will be 2 to 2.5%. The larger contractors, or even the contractors with established bond lines that have CPA reviewed financials, they have bank lines, they hit all 3 C's. It's going to be on a sliding scale. For the most part, their bond rates are going to be more like 1%, maybe less if it's smaller. But it's on a tiered thing. Like the first 250,000 will be say a rate of 2.5%. The next 250,000 goes down to 1.5%. The next 2 million goes down to 1%. The next 2.5 million goes down to, let's say, 0.8%. Next 2.5 goes down to 0.7%. So you can see, like on a $10 million job, the actual surety premium is going to be, and actually it really doesn't matter at that point. It'll never be more than 1% because the smaller guys can't get a $10 million bond. So the only ones that can are the contractors on the sliding scale. So, so basically a $10 million job, the premium is going to be probably, 0.5% to 1%. Hopefully that answers your question, Kirk.
Yeah, that's pretty good. Okay, so we're right up on the time limit here. As for the couple of slides that we didn't get to cover, like I said, I will socialize this with the team, with everybody on the call once we're done, and then I'll wait for the checklist that you share, so everybody gets an insight into what kind of criteria that you guys use to validate those. On behalf of the purchasing division, I want to say thank you. This has been, like we talked about, bonding is not a riveting subject, but it's been interesting because I'm learning And I'm sure for the rest of the folks, if they didn't know it already, it's a welcome review. So
It's about as exciting as procurement, right?
Well, like I say, if anybody has any individual questions or something doesn't seem right, because I'm on a couple of the committees for our association. I try to be very nonpartisan. I don't drive people to our stuff, but just from education standpoint, if anybody has any questions on anything surety bond related, feel free to shoot me an email. I'm very reachable. I'd be more than happy to give you a very nonpartisan or agent response back.
all right, and I am going to take you up on that because I'm developing some stuff for our vendor population. So
Awesome.
once again, thank you guys. Thank you guys on the team for joining on the county side, and thanks again, Barry. Have a good day, and you guys be looking out for some follow-up information from me. Thank you all. Have a good day.
All right. Thank you, everyone.
All right.